Okay, so the point of this deep dive on UL, really talking about the evolution of UL over time, is not really just to push a product here, because we try not to do that. And yes, I'm going to use obviously Sun Life products as the example because it's easier for me to dive into the Sun Life illustration tool and pull those numbers. But you can apply these things generally across the industry. And the reason why we're talking about this right now is because UL, we've noticed that there's a bit of a missed opportunity there. Now, I know Julie mentioned that somewhat when we're talking about PAR, to say that PAR seems to be a bit the flavor of the day. And we've certainly noticed it at Sun Life. Perhaps that's because there's been a lot of drive toward immediate financing arrangements, which is really driving the push to high cash value products like participating insurance. But we are entering a bit of a different environment now. We're seeing that interest rates have been low for a very long time, and they seem to, we thought it was bottomed out, but then it just pushed even lower and lower, making the loan rates and IFAs look very attractive. And for those that may not be familiar, loan rates and IFAs, they're the short end of the yield curve. Bank of Canada controls the overnight rate. That affects your prime rate for the main domestic banks. There's your loan rate. PAR insurance, though, is more on the mid to long end of the yield curve. That's 10 to the 30-year end. Bank of Canada, it may have some very indirect relationship or the impact there, but that's demand driven. So we've seen today, we've got a bit of a maybe even slightly inverted yield curve, or at least it's about flat or at about 3%. Not ideal for IFAs, a little bit risky, and as Julie mentioned, they're very tight on the margins for some of these. So is it the era of the UL coming back? Well, we've noticed that UL has lost a lot of fans over the last few decades, and we think that's because of some of the practices that were being done on UL before had led to certain advisors to just being very apprehensive to price UL, or they're generalizing, where there's been price increases on some COI structures and they're generalizing it across the whole board. And keep in mind, as I talk about some of these changes in interest rates and how UL and some COI structures were priced up, it is all relative for what your clients are otherwise looking at for those similar safe money assets. So we'll dive in. Bit of a longer intro than I intended there. All right, so what we're going to cover on the menu. So first of all, we're going to talk about the history of UL, which, by the way, has been around for about 40 years in this country. PAR insurance, though, has been around for about 150 years. It's about as old as Canada itself, since when it was a dominion. So UL is still a bit of a baby, but it's been around longer in the US. And then when we land on talking about where pricing trends have changed over time from its beginnings, we land on the pricing today. We're going to stay there for a little while. There's number 2, talking about the pricing of the various COI structures, where the market is today, and where there may be some opportunities. And then finally, we're going to land number 3 on talking about how UL fits for your clients. And we're going to compare that using a case study to other commonly illustrated products to show that UL very much needs its day in the sun. Okay, so first of all, talking about the history of UL since its beginnings about 40 years ago in this country. So things were quite different if we look at about 40 years ago. So interest rates were very high, inflation was rising, tax rates were rising, which isn't totally unlike today, but it was a lot higher than it is right now at least. So we're not quite in where we were in the 70s. So PAR was viewed as unattractive because interest rates were so high back then, people just get a GIC and beat that rate, or they'd want something where they can just buy term and invest the difference. So a lot of insurers or a lot of clients were backing out of their PAR policies. They want to just get term, invest the difference. They wanted something else in the market that had sort of that T100 components of the base insurance, but also that accumulation fund bit. So that's when UL was born, because it attracted the more sophisticated investor that wanted to control what they were investing into. And of course, it had more flexibility as well. So the result, everybody loved UL back then. So if we talk about the then period, so interest rates were about, let's say, 10, and they worked their way down to 7% over the next few years. But that pricing interest rate, which is the interest rate that insurers like Sun Life use on the back end, when we take that client's money and we invest it, what we think we're going to get out of it to make sure we're covering those COI charges, the mortality costs, that probability weighting of a death payment, that hadn't really adapted to the times. So insurers weren't actually making any money. So then it was Sun Life, was actually one of the first back in 2002 to raise their UL rate, certainly on the level COI, which was one of the most impacted from this decreasing interest rate environment, when they realized that margins were really getting low. But then, because we weren't the leader of UL at the time, no one else actually followed. Everyone else wanted to say, hey, we've got the best cup of coffee in the world by having low pricing. So then Sun Life had to tuck tail and back out the next year and put their pricing back down. So it wasn't until interest rates the next few years, they then dropped about another 4%. So I reckon we're at like 3% now. Manulife was actually the first to then lower theirs based on that new interest rate environment. And because they were the leader in UL at the time, of course, no one else had to be so cheap, so everyone followed. So then over the next few years, you saw UL get more and more expensive. Some UL COI structures, but not all of them. The ones that are impacted by interest rates. But then you also saw in the minimum rate guarantees. Used to be about 4%. Now it's what, 0 for most UL products. Tax exempt room. A lot of wealthy clients were just dumping in as much as they can. It was basically equivalent of a tax-free savings account. You could throw in whatever you wanted. You didn't get all the tax applied to it, and they weren't going over that MTAR line. Bit different now, where it's very much been squashed down, where they can't just throw in as much as they can, which means a lot more management about so that you'd stay within that threshold, that sweet spot between, you know, lapsing versus over the MTAR line and being in the service account balance. And then also the illustration rate. So a lot of advisors were illustrating, you know, you plop into the UL illustration tool and you throw in a random 8% net of MERs on the funds. Nobody pays attention to any volatility or what the fund fees are. You just throw in a percentage, and that was 8% at the time. Of course, that didn't really materialize. So then a lot of them had to go hands out to their clients when in reality things didn't happen that way, and that's what led to all this apprehension we have today. Because it's been a long way down since then when we think about interest rates. Now, this graph was submitted, as you can see, before when these IDC events started. So interest rates have actually changed a lot since then, and it's tough to keep up with these. So it started out, we're looking at like, you know, near 10% when you think about the mid-90s. But it's been a bit of a downhill slide since then. So like I said at the beginning, actually, a lot of insurance is invested in about the 10 to the 30-year end of the yield curve. You'll find most of them are about the 10-year mark. So for PAR and where they're investing for UL, look at the 10-year government account yield curve to get the best idea of the long-term general direction of where pricing is going to go. Okay? IFA loan rates, short end of yield curve. They may have other assets and whatnot, but this is your best leading indicator for any insurer. Okay, so you can see it's been a downhill slide since our beginnings for UL. So it went down to about 1%, and then it bounced back up, and we're at what, 3% now. But there's so much volatility; it's really quite tough to say where these things are going to go. Certainly in a recession, we've got a bit of inversion on the yield curve, and that's never not led to a recession in this country. So I'm sure the Bank of Canada are going to want to try and control that in some way. But if I were to continue this and submit a more updated graph here, you would have seen this bounce back up to about 3%. But either way, we are much lower on the yield curve on the 10-year government accounted bonds since when this started. And that impacts pricing. Because remember that pricing interest rate I mentioned that insurers are earning, they're not earning as much as they used to be. So let's look at where we are today. So today, I don't know actually what the pricing rate is the insurers are going to do, because they don't actually tell us. And I like to think I'm on the inner sanctum, but unless you've signed that NDA and you have your cult hood on, you don't get in the door to find out what these prices are. But my guesstimate is that they're using about somewhere between 2 and 3%. Okay? If you asked me 6 months ago, I would have said somewhere a bit less than that. But there's probably a bit of a lag. My guess is somewhere between 2 and 3%. We're at 3% the 10-year right now, but they're going to have some estimate about where they think things are going to go. But either way, we're looking at about 5% reduction from where we used to be, you know, about 10, 15 years ago. And that affects things in the pricing. The minimum rate guarantees, like I said, we're at 0% now. The tax exempt room is very much different from where it was. And advisors are now often illustrating at the guaranteed minimum. They're just so apprehensive about UL now that they just illustrate as 0 because they know it's guaranteed. But the question is that being overly conservative? Is it really going to happen that it's going to be 0? In fact, some of these, because we even see the trends at Sun Life, very few advisors are using equities in their UL because they don't have to manage these things. Most of them are, at best, they're using the blended fund, which is heavily in fixed income, or they're in the guaranteed interest account, which right now at Sun Life is giving 3%. It just went up. So I think I've got that listed somewhere here, and it's going to say a lower number. But like I said, these things are changing pretty quickly right now. So here is how pricing affects things. Okay, so we can see in the graph here, if you look at this red line, so it looks like a YRT curve. Well, that is your mortality for the average person. So as morbid as this sounds, the older you get, the probability of you kicking the bucket goes up a notch, right? So as you get older, and that's a cost to the insurer. So this is your probability weighted payment of the death benefit for a client. However, if a client buys a level cost of insurance product, obviously they're paying it like the black line. It's a level cost. So what that means is, since it's level, in the early years, there's some overfunding there that the insurance company gets. And they're investing that on the back end. And that's that pricing interest rate I mentioned. They were doing that 7%. They were slow to pick up and adapt to that, praying the interest rates are going to go back. And they all wanted to say, we have the world's best cup of coffee. We want to beat Man U. We want to beat Canada Life. Everyone's trying to do that game theory of being competitive. But it's not sustainable, and they had to adapt to the reality of where interest rates have been low for long. If interest rates go down, meaning the insurers are earning less, then it's actually going to look a little something like this. If we're not going to earn as much on the back end, that means we need to charge Mr. and Mrs. Client a little bit more so that we can invest and still earn the same amount overall. Okay? And for every 1% decrease in that pricing interest rate is roughly a 10% increase to the cost of insurance to the client. All right? So it's going to differ depending on if it's male, female, smoking status, rating, or how it's structured for the payments. But in general, that's how it works. So where has the trend of sales been going? So this is where I'm going to draw that corollary to Julie's great presentation before. So it seems to be that it was par, and then it transitioned to UL. I talked about the beginnings of UL, and it's gone back to par. But this is where we talk about, we really need to think about where things are going and the direction. So it makes sense if you think about the history that it took things away from UL. There could be opportunities for UL. But more importantly, what I want to focus on right now is that the generalizations, even over the last few decades, the low interest rate environment, there's been a lot of missed opportunities that could have been had about certain COI structures in UL. So for example, what you don't see on screen here, and it's going to be related to this UL discussion, I actually want to talk about term insurance. Now, term insurance, I took it off this graph here because you get the idea where it's, if I look at the data, it's actually just been 25% market penetration of insurance sales across the board. So it's easy to remember. So 25%, so I just took it out so you didn't see another line for that noise. Why it's interesting is term insurance has actually decreased across the industry about 50% in pricing. And that's because if you think about the pricing of any insurance product, I'm going to oversimplify here, but I want to talk about four main components. You've got interest rates, for some of them more than others. You've got mortality and lapse experience, and then you've got market competitiveness. Now, term insurance, though, is not impacted by that first one, interest rates, at least nowhere near to the same degree. And it matters depending on the length of the term and whatnot, because it's invested on a YRT scale on the background. Nothing significant really happened on those middle two, mortality and lapse experience. But on term insurance, you can be damn sure on that market competitiveness, that has changed. So pricing has been so aggressive because we've seen a lot of fintechs come into the fold, competing direct to consumer solutions, where people were shopping with different insurers based on, this one I can get an extra pack of gum by the amount I'm going to save. But now it's so close in pricing, nobody cares. You go with this insurer because their electronic app looks prettier. I like that they use clouds or something fancy. It's no different. But the point is, since it's been consistent over that last decade at 25%, it shows how market penetration has not changed, even though pricing has come down about 50%. Why? Because either you have a need for term insurance or you don't. That doesn't really change. It's a different discussion to talk about your permanent insurance, which is a want discussion. tax strategies, you're planning for legacy, a greater net to estate value, corporate strategies. It's a very different discussion. Now, this is very related to the UL discussion I'm going to be having in a moment. So now we're going to talk about today's UL and where there has been changes in pricing over the last 10 years and where I think there really are some missed opportunities. So we can see on screen here, this shows the, it's quite small, that font, isn't it? It's the difference in pricing in Sun Life's UL. So I'm going to show the different COI structures since our pre-2010 pricing, okay? So how this works, let's just focus on the first one, the male 30 non-smoker. So compared to the pre-2010 pricing, you can see that, for example, we did a first round of price increases in 2010. So you can see 17.9%, that pricing went up, okay? And then in 2011, you can see the light grey there. Again, we're on the male 30 non-smoker. You can see there was another 14% of price increases. So you get the idea. You add all those up to our more recent price increases. You can see there's about a 95% price increase over that last decade compared to the pre-2010 pricing. And I know what you're thinking, why are you showing us this, Mark? Isn't this look brutal on Sun Life? Well, Sun Life actually has one of the most attractive pricing for life pay and limited pay as well. So really you can generalize this across the industry. Why? Well, just like that graph I showed you with where I showed that moving line, it's very much impacted by interest rates, so pricing has increased. What about the 10 pay? Well, on average, actually this went up even more. The last one I think was 50%. This one is 70% increase on the 10 pay. So this one was even more brutal on the average price increases. But it's important to note, you can see that the price increases are very much different at different ages. As you can see, at the older ages, because of the longevity, how long that's getting invested for, the mortality and whatnot, they're nowhere near impacted to the same degree from those interest rates. So I hope you're seeing here, it very much depends on the client. You should be running it for each client and not generalize on these price increases. And again, this isn't just Sun Life, this is across the industry. Guaranteed 20 pay. This was actually less of a price increase than all the others because of how it was reflected based on interest rates and how long that needs to be invested for. So you can see we actually had a decrease in 1 year for the male 60. If you add all those up, I think it's about 4.5% overall, that increase. So the point is, before I move on, with all of these, you're thinking that, okay, Raw, you're telling me is don't look at life pay and limited pay. Well, that's actually not what I'm saying. I'm saying that you should be checking out for your clients what is appropriate. Understand it is lumpy in the pricing, depending on different ages. I can look at different ratings, how they're going to structure it for funding it. So it very much depends for each individual client. And also keep in mind, it is all relative. Any client that's looking at a life pay or at least a limited pay, they're somewhat risk averse, right? And what is the alternative they're considering? Well, for any of Sun Life presentations, we often, if you've seen many of them, we often throw in a Capgemini report that talks about where the wealthy are investing. And you'll find that over the last 10 years, if not longer, they've been investing about 45% for every region across the world in safe money assets. So that's cash and equivalents and fixed income. So that is, in the last 10 years, a pretty terrible interest rate environment where you get negative yields on some of those bonds and they're still investing that heavily in safe money assets. Why? Because the wealthy are rich and they want to stay that way and they don't want to lose their money to tax erosion and market volatility. These are a very attractive alternative than have it just parked in a bond. In fact, many of them would have preferred to have it in a UL policy than in a bond that's going to get that seesaw impact from interest rate environments. But you're probably wondering, hang on, you missed one out there, what about YRT? Well, the question is, did those interest rates have that same impact? And this is why it's relevant that I talked about term insurance, which didn't have that first element impacting all those pieces of the puzzle for the pricing. So UL YRT is a very different story because when it's invested on the other side by the insurer, they only need to invest it for 1 year each time. So it does not have that they're planning for that pricing interest rate for many years down the road, meaning you completely remove that pricing impact on the insurer. In fact, the customer takes on that pricing impact. Is the difference between whether you got a defined benefit plan or a defined contribution plan. So the customer can choose, and therefore they can choose whether they go into equities or more bonds. They can move between the investments. They have that control. And it is the era of the YRT. Because although, yes, I'm very proud that Sun Life has one of the best pricing on limited pay and life pay COI rates for UL, it's also like us saying, hey, we've got the best price cassette tapes. So that's why it is the era of UL. So to demonstrate this, like I said, I'm using Sun Life as the example. I'm going to show you Clarica UL to begin with. Now this is the Sun Life before Sun Life. How am I doing for time? This is the Sun Life before Sun Life. So imagine with me, you've got a client that's just investing the bare minimum each year. So it looks like a YRT scale because they're paying it on the YRT scale, the COI charges. So you can see this is the UL Clarica, the YRT 100. Okay, so in this instance, the client actually had a negative internal rate of return, the IRR, at age 85. Okay, so it gets the slap on the wrist by eating too much broccoli at age 85. What about the Sun Life YRT 100, which we came out with in 2006? So it's actually doing a bit better here. You can see the pricing has come down. Here, the IRR goes negative, though, once they hit age 90. So it's a bit better, but well, they still have to live fast and die young, right? And then we have the UL YRT 85 here. So the last two are YRT 100s. Now, this one is not exactly apples to apples because it is a YRT 85, but I think you get the idea because even in those first 85 years, the graph is even lower, right? And then, of course, there's no charges from age 86 and beyond. So for this client, it's a lot cheaper compared to those YRT 100 policies. So it really shows the decrease in pricing. And why? Similar to our term story, not impacted by interest rates, nothing really eventful has happened on the mortality and lapses. As Julie rightly mentioned, when it comes to par policies, they can be kind of messy with how they apply their assumptions. The experience can be very different between insurers when it comes to par policies. It's a bit different when it comes to the UL because the insurance company is going to eat it if they are too aggressive on their mortality and lapse assumptions. So there's nothing really too eventful there. But then we have that last component I mentioned, which is market competitiveness. And it has become more and more competitive for UL YRT. So pricing has come down across the industry over 50% over the last decade. So you can see that showing here, meaning, yes, some COI structures saw price increases, like I showed you with the level and limited pay. At certain ages, it wasn't much of a price increase. So you should be looking for your client depending on what they are looking at elsewhere because it is all relative. And then we see on YRT is never been more affordable. But nobody's pricing YRT. Nobody's looking at it because everyone's apprehensive from those behaviors that were done before. It got this bad rap. Nobody likes equities in the ULs. Nobody wants to manage it. I'll admit, when it comes to insurance companies, even though we are in the long-term client business, in-force support is abysmal for every insurer. So there is some management for you, for your clients, if you're looking at a YRT, certainly with equities. But there is a lot of opportunity here in terms of the numbers, and no one is looking at it. You can see that in the sales trends. So one of the other things to focus on with UL, I'd be amiss if I didn't at least highlight it, is that it is a simple product. And a lot of clients like that. It's all itemized in the cost. You just pay, have your deposit, premium tax is taken right off the bat. Depending on, the province, it's about 2%-ish, up to 4%, depending on the province. And that goes to pay the COI charges. Anything over that goes into the fund account of the client's choosing. And anything above that goes into the service account balance if it's over that MTAR line. So, sounded like I said a lot there, but it's itemized. It's nice and simple, doesn't change. It is not that black box of par insurance that we all hear about. What about par? Now, Julie already mentioned a lot of this, but par is often referred to that black box because I don't know if you noticed there was an asterisk somewhat in that last presentation that I really liked. It very much relates to this, where it was at the subjective discretion of the board of directors for the payment of the dividends. And that pretty much summarizes what you need to know when it comes to par. Now, it is a zero-sum game, and I'm just going to focus on the shareholder scenario because it applies to most par. I know it's a bit different when it comes to the mutual scenario. Now, with par, there's only so much an insurance company can take away from it. You know, the 2.5%. It's all regulated. I'm not involved with these discussions, but I can almost guarantee there's some lobbying going on to try and get that increase, because PAR's it's like selling milk at a grocery store. It's like a loss leader. It's a low margin product. Shareholders don't like that, so they would like to increase it, but they can't take more from it. So it's the same for all insurers. So when they do all this stuff about playing around with the experience, the assumptions when it comes to PAR, think of it like the economy. The growth in the economy has a set line based on your gross domestic product, your productivity, and we got liquidity pumped into the market by the Bank of Canada, the central bank. It brings that forward with that liquidity for that productivity, but then you have to pay for it at some point. Okay, so that's why you get recessions and you get booms. PAR's kind of the same way. If you get very aggressive with those assumptions, it's a zero-sum game, where if you're very aggressive now, it has to be paid for later. Okay, it's not that the insurers can suddenly take that and we're going to give that to the shareholders. It's all very regulated. But it makes it very complex when trying to plan these things for, let's say, an IFA. You think you're running all this complex mathematics, but all you're doing is math magics, right? So consider yourself magicians. So I'm not going to go through this formula here. In general, though, what you see here between these main sections, it's based on the investment portion, as you can see in green, and everybody thinks, oh, I'm illustrating, I solve it by putting my illustration tool as my DSIR. That's that one thing you can toggle. Well, that's actually not the entirety of even just the investment portion, because that's compared to an assumption, which can change at the subjectivity of the insurer, but you get to toggle that one little piece. There's also mortality and lapse experience. Even if you knew what the assumptions are, which you don't, you can't toggle them on the illustration anyway. And then you have the red portion, which is surplus and expenses and taxes and other fun stuff. Point is, it's a lot more complex than UL. So what we've noticed when it comes to sale trends is that regardless of what COI structure people get, they always want to pay it in 10 years, roughly 10 years. And we think that's because everybody just wants a simplicity. They want to know that, you know, I've got my 10 years till I retire and I'm done. But then it raises the question of, does it have to be a guaranteed 10 years? So I've already shown you this pricing difference between all the different COI structures. And really when it's that consideration of price of a guaranteed 10 pay versus an alternative, you're having that different discussion about opportunity of saving money or having more growth, or the comfort, the risk they're taking on, okay? For example, if you've got a client that buys a YRT 85 policy, and now think back on that graph I showed you that had that YRT scale of the mortality. Now for a client that gets a YRT 85 policy, they've got it going up for 85 years and then there's no COI charges thereafter. If they were to fund it in 10 years, for example, they're overfunding for those 10 years, and then they need that overfunding, they funded it well enough, that it's going to cover the latter years where they're not doing any funding, in a sense, to cover those growing COI charges, the YRT charges. So when they do this, the question is, at what rate does a client need to earn on that early overfunding, and for the latter years as well, to make sure they did just as well, if not better, than the guaranteed 10 pay equivalent? Well, we ran lots of scenarios to test that, and it's actually a lot less than you might think. And I'm going to refer to this as the hurdle rate. The reason why I show this is because we know, and I just showed you all the different opportunities with savings, because the pricing has really come down on YRT UL. A lot of clients are still apprehensive because they don't want to take on this additional risk. Well, this is to show you that they're really not taking on additional risk, or it's minimal risk at least. Now, I want to highlight the difference here to make sure we're on the same page. There's two main death benefit options when it comes to UL. Now, Sun Life, we have three more than this as well, but I'm not going to go into all that. The point is, the main ones are level and face plus fund death benefit. Now, for example, I'm using here, which is when a client just wants to achieve the maximum death benefit they can and min fund it, they don't care about growing death benefit, then level death benefit is for them. Why? Because it's got a decreasing net amount at risk over time. So if they get more growth in their fund value, it decreases the COI charges because of that. So they get more chance of a premium holiday. So it's great for business owners that want to decrease risk. So great for clients that are focused on risk reduction, but still want to consider perhaps a YRT policy. Later, I'm going to talk about Face Plus Fund, which is for those that want to grow the death benefit, or perhaps even want to have the ability to tap into the cash values. That's separate. Okay, so back to this hurdle rate. I said, what is the opportunity here? So for clients, let's say we've got a client that has is a $1 million policy for a male non-smoker age 50. If this chap were to get a guaranteed 10-pay policy, you can see in the top right, it would cost him $41,105 for 10 years. Okay, for the guaranteed 10-pay. Now, if you were to buy one of the alternative COI structures, let's say guaranteed 15-pay, 20-pay, level, YRT 70, YRT 85, what this bar illustrates is the rate of return he would need in that policy for the life of the policy to just survive until age 100. Meaning that if the policy did any worse than this hurdle rate, the policy would elapse and he would have been better off getting that guaranteed 10-pay. If it did any better than the hurdle rate, though, he would have had better growth in his fund account, which meant it decreased his net amount at risk more, and he could have ended up depositing less in the latter years. Okay, opportunity for saving. He could end up spending less than the 41 grand. He could put in, say, in some cases, 40,000 or 39,000, and it still would have survived. He could have spent less for the same level death benefit coverage than if he bought the guaranteed 10-pay. Now, the point is, what I want to show you is, now look where these hurdle rates are, as shown by these bars. They are all very low, meaning that if he were to get for any of these policies, he would have been giving up very little comfort to get that same level death benefit. In fact, the winner here is the YRT 70, which has the lowest bar. You can see the hurdle rate here was just 0.1%. Meaning if this chap were to get the YRT 70 policy instead of the guaranteed 10-pay, if he achieved anything better than 0.1%, he would have been doing just as well, if not even better than the guaranteed 10-pay. If he got 0.2%, he could have had that policy with the same level $1 million death benefit. He could have spent something less than the $41,000 for the 10 years. Maybe it's $39,000. I don't know what the exact number is. But there's a good chance he's going to do better than 0.1%. In fact, our guaranteed interest account is paying 3% right now. The Sun Life diversified account is paying 3.85% right now. On these graphs, you'll see that because these were submitted before we changed the rates, this SLDA, we quote it as 3.5. We've recently bumped it up to 3.85. You can see in comparison where our hypothetical equity fund here, we've shown the TSX, the average return over the last 25 years, minus a 2.2% management expense ratio, MER. So that's at 5.75. You can see the chances are, if we see comparables, the hurdle rates are very low. Your clients have a very good chance of beating it. Not guaranteed, of course. I've got to do the CYA thing here, but very likely. So if we look at all the different age groups, you can see, for example, there's our age 50 there, just to the right of the middle. You can see at age 20 here, you can see our winner again was the YRT 70. In fact, the winner for all of these is summarized at the bottom. You can see the YRT 70 was the winner in most cases, and then it went up to the YRT 85. So why? Well, I showed you all the different price changes, and that was just for Sun Life, but you can generalize this across the industry. YRT has become more and more affordable, pricing has come down, and pricing has gone up a bit on some of the others, depending on the ages and what COI structure, and come up a lot on some of them. So comparably, YRT looks very attractive, certainly in comparison to the guaranteed 10-pay. And this is what I mean about the opportunity for savings. So what if you did better than that hurdle rate? Well, if you took the respective winner from that last graph, let's say the YRT 70, which was then became the YRT 85 at certain ages, if you achieve 1% on average within your fund, you could deposit 2% less than what the guaranteed 10-pay equivalent would have charged for that age group. Going to the extreme, if they achieved 5% average return, they could have deposited almost 40% less. That's quite the saving. And even if they didn't earn the 5% in their fund, their hurdle rates were so low, as I showed you on the other screen, they're still going to do better than what the guaranteed 10-pay did in most cases, unless they had a very low hurdle rate. Very low actual return, sorry. So how do you get there? Well, of course, this is a little old now, where we submitted this a few months ago, but these numbers have already increased because of where interest rates are. So the guaranteed interest account is actually now about 3%. Our Sun Life diversified account says 3.5. It's now 3.85. We just bumped that up. Is what we're paying. That's our blended fund, by the way, and I'm going to focus on that a little bit more on this slide. So our Sun Life Diversified account is by far where everyone is putting their money at Sun Life. So that's great. Obviously, we love that. But everybody, they're doing this because they want that. We're just dipping our toe in equities when it comes to our UL policy. Nobody wants to touch equities because they want to manage it. So the most risk they're willing to take is the SLDA, or we're seeing people in the very safe, they're going just the guaranteed interest account, one of the fixed income funds. So people often ask us, what should I illustrate my SLDA fund at? And we believe it should be at current -1. So at the time we did this, our current -1 said 2.5. Now that would be 2.85. But we believe that current -1 is appropriate. Same thing you do on your par policies. Well, if we look at the breakdown of the SLDA fund, for example, and you'll see with the other insurers, they've got their own version of it, which is fairly similar. You'll see the fixed income, we've got about 80% in fixed income, which is actually a tiny bit more conservative than our par account, which is 67% in fixed income. Now that's broken down between bonds, private fixed income, and mortgages. Now the remainder, 20%, is from real estate and equities. Now if I use conservative assumptions based on what our historical returns have been in these funds, and I multiply those out, you'll see this is very close, using very conservative assumptions, to that 2.5 I mentioned. So I would bump this up now based on where interest rates actually are, but obviously this was submitted a few months ago. So you can see fixed income, we've got 80% weighting. If I use a conservative return assumption of 2%, so that is conservative, by the way, because we have, of course, across the durations on fixed income, they weren't all invested at the low end of the yield curve. Some of them are the longer end. Some of them were invested many years ago, so they are at a much higher return than the low rates we're at right now. We've also got private fixed income, which typically earns about 350 beeps above corporate bonds, and similar for mortgages, is about 350 beeps above corporate bonds. Okay, so 2% is a very conservative assumption. Multiply those out, gives you 1.6. We'll do the same thing for equities. A conservative assumption based on what we've historically earned is, we'll say, is 6%. So historically it's been about closer to 8-9% since it's been the funds used for UL. Take away some hedging costs for expenses, and then we have 2.3%. Okay, so very appropriate for your 2.5, which I would recommend using higher assumptions now, 2.85, current -1 for the SLDA. Similarly, you have equity funds. Now, like I said, nobody's really putting into equity in the UL right now, but I really think there's a missed opportunity, which I'll touch on in a moment. Now, with any fund, you have to be careful that historical returns don't guarantee future returns, more so with equities because of volatility there, and whenever you plop in this stuff in a UL illustration tool, you can't play around with volatility, and you have sequence of returns risk with a UL policy. It's like a retiree making withdrawals. You are making withdrawals to pay those COI charges. So you have sequence of returns risk with a UL. Volatility matters. You can't touch that though when it comes to an illustration tool, and the only way you could anyway, other than running a few random generations, you'd have to do a Monte Carlo simulation, which is running thousands and you run an average. For obvious reasons, we don't get into that. But the point is, you can see that these average returns, net of fees in our UL, is much higher than those hurdle rates I showed you. So now I'm going to show you a case study about how we can fit for your clients. So I'm going to use, again, I'm using the level death benefit here. I want to show you that UL, many advisors are missing it in their analysis, but it really can look quite attractive compared to other common alternatives. So if I look here, the UL YRT 85 with level death benefit, I've got min funded using that 2.5% I had there. So SLDA -1, well, it would actually be even higher than that now. And I also look at 0% interest rate for your nervous Nellies. And then versus a UL guaranteed 10 pay. And also I'm throwing in some par. Since I'm using level death benefit and we're focused on high death benefit here, so I've used Protector, which has more focus on the death benefit. I've used guaranteed 10 pay at current -1 dividend scale. And then also a life pay with max plus premium at current -1. All of these have the exact same deposits, 10 times 100 grand. So as you can see, and I'm running low on time here, I want to make sure that I just get the summary here, which is that UL looks very attractive. So I'd say the winner here is that top green line, which is the YRT 85 at my conservative 2.5%. So probably the next closest, I'd say, if not comparable, depending on what the client wants, you're looking at the life pay protector, that pink line. But a lot of advisors don't even include UL in the discussion. And for some clients, this is much closer to what they want if they want that high initial death benefit, but it never got analysed. Everybody just thinks, oh, it is the time for par, just look at par. And then you have those other qualitative benefits of UL, like the simplicity, you have the increased possibility of an early premium holiday, which I'll touch on later, and the more control. What about net to estate? Now, because UL arguably has a faster grind down of the ACB, that leads to a higher net to estate value for your corporate business owners. So I'd say it even pushes it slightly further in the direction of UL YRT 85 here. What about cash values? Well, I just included this for full disclosure. UL looks awful here, so I just really want to show that, yeah, I'm not lying. I'm not going to try and hide this. If you want cash values, then you're either going to look at par, perhaps the par accumulator, if not even the par protector, because it's got the very high early cash values, or at least if you're going UL, you're going to look at face plus fund, so you can tap into those cash values and grow the thing. But the point is, you're probably not going to get a level death benefit UL if you want cash values, but also, nobody wants cash values, right? So some business owners don't even want cash values. Nobody's running an IFA. If you don't want the shares to increase in value, if you're doing pipeline post-mortem planning strategy, you don't want cash values. What about if you're just looking at for the death benefit, the legacy, you just want the death benefit, then you don't care. What about your commissions? Obviously you have to get paid. Let's just focus on the first column of numbers here. Well, we've present valued the commission to today at 2%, okay? Discounted to today's money. You can see it's very similar across the board. So the point is you're not really giving up anything when it comes to your commissions either. And of course, we just had a pandemic. So it's very important to think about the benefits of UL when it comes to the flexibility. Now, in COVID, a product like UL became a bit of a safe haven. People didn't want to be worrying about also their insurance product to make sure they're keeping it afloat when they're also trying to pay their salaries to the staff, keep the lights on. They don't want to go under on their lease and then have to move later. So having this was that safe haven product. So let's look at some of the stats that were found from this poll from Stats Canada and CIBC. 81% of business owners were negatively impacted from COVID. 77% said that sales dropped. 32% were worried about the viability of their business over the next year. And 20% of businesses with less than 19 employees were unable to take on more debt, so small businesses. So the point here is that all, to me, sounds like it's a cash flow issue. They needed to make sure they had enough available cash to get them through this volatile environment. And having the outflow for their insurance was not something they needed at the time. They needed something that was flexible. So we wanted to show this because we know that UL is so flexible. How do we test this? Well, we compared premium holiday, which is you've been paying your premiums, everything's hanky-dory, and then all of a sudden you stop. Because, let's say, COVID hits and you need to cover your expenses. You don't have revenues. You're not getting the inflow of cash elsewhere. You need to make sure you can tap into your piggy bank to cover things for the business, and you need things to not be going out to that insurance policy, at least for a little while till you get by. Well, UL became that safe haven. And to test that, we've used the exact same policies I showed you a moment ago. Okay, so the YRT 85 UL, I had the guaranteed 10 pay, also had the par protector. Now, if we were paying our premiums for that 1 year, how much of a premium holiday could I take? Now, to test this, what we've done for the par policy, it goes into automatic premium loan if there's enough cash value to do so for a full year, or 2 full years, or 3 full years. And for the UL policy, because it's paid in 10 years, like I mentioned, there's overfunding, and then your lower fund, underfunding in the latter years. Was it invested high enough to cover that? Was there enough in that fund value? Did I have the overfunding for that decreasing of the net amount of risk I talked about? Was there enough that I could just stop my payments for 1, 2, 3 years? Well, you can see the results here. The point is, when it comes to the par policy, and again, to be fair, I'm using par protector, not the higher cash value par accumulator. But in this par policy, there wasn't enough cash values to do a full year. Now, if I showed months, it might have something there, but this is just showing full years here. There wasn't enough. You couldn't take a premium holiday, so you're in trouble. You need things to be going well if you've got par. It's a high barrier product. It's for the wealthier, and you need things to be going your way to pay the premiums. What about UL? Well, it was very flexible here. to tap in and rely on that to cover those COI charges. In fact, for the YRT 85, when I solved it, there's a difference between 0% and 2.5%, by the way, because it's a different face amount, depending, because I'm maximizing the death benefit. So there's more overfunding in one than the other. So, but you can see it's much more flexible when taking that premium holiday with the UL. And then after 2 deposits, well, it just exaggerates things further. I'm even further away on the UL. Finally, I can take a premium holiday for 1 year on my life pay par. So now you're probably wondering about, well, what about that other one I talked about, the Face Plus Fund? Not everybody wants just that higher initial death benefit. Well, if we want to grow these things, we know, and I put clients really to 3 buckets. You've got your familial support. You know, you just want to cover for your kids or your spouse, or maybe key person protection. For business, you got your business pillar, so we've got to make sure we're keeping the lights on and whatnot to make sure succession planning for the business. And then you have your savvy investor, which I think that is a growing element in the industry for a lot of our clients, because we know where demographics are, people are getting more informed, mutual funds, everybody's talking about MERs, looking at ETFs, direct-to-consumer solutions. It's the same when it comes to insurance. People want a product that they control. Everyone's becoming a savvy investor. And for them, the attraction is often going to be Face Plus Fund, because they want to grow it. They love the fact, talking about the old ways of UL, they love the fact you can throw some money in it and it's an alternative. I've maximized my RSP and TFSA. Is another alternative to grow a bit tax-free while inside the policy that you can't do elsewhere. One of those little fun things that wealthy individuals get in the policy. And now to test this, what I've done really, when you're comparing this, you're not comparing against fixed income like we always do when it comes to insurance. Here, if they're trying to grow the policy, we really want to test it comparing against if you invest in a non-registered fund into equities. So what I did is I ran some tests, and by some I mean 500 with about 2 weeks of no sleep. So for this, we compared in a UL policy versus if you're in a non-reg equity fund, and I was very generous on the taxation assumption for the equities here, fully into capital gains with just 20% annual turnover, and our current capital gains inclusion rate of 50%. Okay, basically saying a low taxation assumption, because most non-reg equities are going to be in a little bit of fixed income, or at least a lot of dividends, which is arguably going to be a higher taxation rate. So point is, I assumed low taxation on the equities here. Okay, to be even more generous to the equities and still show you how UL can look good against it. So I'm just going to show you the quick summary here, as quick as this is possible to be. And I actually want to draw your attention to the top right there, which actually shows you the main gist of your takeaway. And the point is, if I look at different rates of return, I mentioned sequence of returns risk in the UL policy because it is doing withdrawals to pay those COI charges. Okay, you don't have that in the equities, unless of course you're dealing with a retiree that's making withdrawals for their income. But in general, you don't have that in your equities policy, but you do on the UL. So that leads you to a lapse risk on the UL. And you don't have a lapse risk on the equities. Yes, it can dwindle down to 0, but anything short of 0, there's still something in there. But there's a threshold in the UL where it's going to get pulled away from you. Its policy's gone. So there's a point there where at a certain rate of return, the UL policy is going to lapse and the equities would have been better, even though you get the tax benefits in the UL. There's a threshold there. What about very high rates of return? Well, the equities win here too, because the UL has a risk of it pushing into the service account balance, where all of a sudden your rate of return's crap and you're getting taxed. You don't have that in the equities, forgetting the fact that, assuming a client gets pushed into a higher marginal tax bracket, but avoiding that noise. The point is, on the UL, you have that service account, the MTAR line to worry about. But between there is a sweet spot where you get the tax benefits of the UL where it just destroyed the equities. Meaning the clients have that better alternative to a non-reg if they invest in the UL and grow the money that way. And then of course they have the risk reduction that an insurance policy offers. So if they can stay in that sweet spot. What about different fund fees? Because everybody's focusing on fund fees, certainly our savvy investor right now. So, well, there's a threshold here where if the fee on the return on the UL policy is such a rate higher than what your client can otherwise get in the equities, then yes, it doesn't matter if you're getting it tax-free on the growth in UL policy, it erodes those gains. Okay, if we just assume all else is equal, where a higher fee results a 1-to-1 reduction in your return. Okay, That's assuming, let's say your client has an F-series fund in their equities or a low-cost ETF index. So there is a point there where fees can erode the cost. But until that point, the UL policy did much better because it has that tax-free growth, which they don't have in their equities. And again, I was very generous on the tax assumptions on the equities. And I already talked about volatility. The only way you can incorporate volatility when you've got sequence of returns risk is with a Monte Carlo simulator, which is if you have a computer tool that would run hundreds of thousands of samples of scenarios. You run a regression, so an average of those, and that gives you a probability weighting of what it would be. We don't have that. It's sophisticated software. None of you have that. It's not in Excel. You can randomly generate it. It's not the same thing. But the point is you have sequence of returns risk in the UL that you don't have in the equities fund. The scenario actually works out the exact same way as that rate of return I showed you. If volatility means that your returns in the early years, where the overfunding is so important, are very low, you're going to more likely have lapse risk. Exact same as an early retiree. Same thing, if your sequence of returns pushes it into above the service account balance, you're going to push it into there where you would have been better in the equities as well. Okay, so volatility is not your friend. And maybe that's why everybody's been avoiding equities in the UL. So how do you manage it? Since I'm talking about the opportunity on growing this money in a UL policy, well, how do you manage it and still have the opportunity with equities? Well, I've been making these corollaries to a retiree, and that's why you should be using a retiree strategy. How do they do it? Well, they use a cash wedge strategy. So if anyone that are wealth-minded here, that's because you have an element in your investment, and you can pick more than one fund in your UL policy. Let's say you have some money for the next 1, 2, or 3 COI years of charges in your low volatility fund, the SLDA fund, and you have the rest invested into equities. When the market looks good, you drip it from your equities into your SLDA fund to cover the COI charges for the next few years. Now, a lot of clients in their retirees, they'll have in equities and a GIC. They'll drip it from the equities and the GIC, cover the next few years. When that expires, you top it up. It's the exact same thing with a UL policy. Here, that means you're managing the risk management to cover COI charges. You're only dripping from the equities when the returns look good, selling high, and you still have that growth opportunity. You're keeping it in that sweet spot I talked about, that band. Your clients are growing their assets tax-free where they otherwise couldn't, and they're destroying their equity alternative. And for you, it's not taking on too much risk management because it's nice and simple. You meet with the client once a year or once every 2 years to drip over how are we looking, and then you are beating the alternative. So to quickly summarize, I've got a few minutes left here. UL has a lot more flexibility. I'll show you about those premium holidays, which was the safe haven in the COVID pandemic. It's a lower cost of entry compared to par. So that's why we see it's often that transition product between some people, do they go from term to UL because it's got the higher initial death benefit, but also has an investment component. It is a lot more attractive for those savvy investors because of that control. And then, of course, you heard the differences between a bit of Julie's presentation, the transparency in UL versus what we have in par. Par is a great product, of course. We love it. And of course, we'll keep taking your business at Sun Life. But keep in mind, there are opportunities because not every client is the same. Clients are unique, and therefore your solution should be as well. You don't want to be a one-trick pony. At least examine where UL fits. And for some clients, they really like that transparency, and it's easier for you to explain these things to your clients. There's many investment options, so we talked about that. And of course, a lot more client control. So please check out our Rethink series. So I gave you the long-winded version today for the hurdle rate. But we actually have, if you have a chat with, say, Jana, Neil, and Nelly at the back there from Sun Life, they'll give you our Rethink series. There's a 1 or 2 pager, and there's other relevant articles as well. This gives you the quick hit story of how that hurdle rate works. Now, I know I whipped through it today, but the Rethink series is all about being concise on thought leadership. So you'll pound through 3 of these puppies before you finish your morning cappuccino. They're very quick, give you some quick thought leadership. This explains the whole story very succinctly in just 2 pages. So check that out. That is all about the Rethink series, which you can find it at, we actually just rebranded this website. It was sunlife.ca/advisor best practices. It's now /consulting. Okay, so it's the Sun Life Consulting site. My team has been rebranded to the Sun Life Consulting team. Also, whip out your phones, scan this QR code. So this is our Voice of the Advisor platform where you guys can give your feedback to Sun Life, and we want to hear from you. We really do take this and show you how we're applying your feedback. So be brutal about your thoughts about Sun Life and what you want to see from products, services. They are putting a lot of money into this to make sure they're listening to leading advisors like yourself. So please give that a scan. I'm going to leave that up while I just see if there are any closing questions. So thank you.